All right, let's get right into it. Today, we're digging into the latest financial results from Murata Manufacturing, a real heavyweight in the world of electronic components. They just dropped their first half numbers, and believe me, there's a fascinating story here. We're talking currency tailwinds, booming AI demand, and a business performance that's basically split right down the middle. Okay, let's start with the one number that just jumps off the page, 41.1%. That is how much Murata's operating profit for the first half of the year absolutely crushed its own forecast. I mean, that's not just a beat, that's a massive outperformance. It really signals that something big is going on. So the question is, how on earth did they pull this off? And this table here, it shows you just how much they blew past expectations. And it wasn't just in one little area. You can see it right across the board. Revenue, operating profit, net profit, they all completely smashed the targets they set for themselves back in April. Revenue was up almost 9% over the forecast. And profits? Well, profits were up over 40%. This wasn't just a slight beat, it was a total blowout. So what were the key drivers behind these incredible results? Let's get to the first big reason. Because you really can't tell Murata's story right now without talking about this huge external factor that gave them a massive boost: the currency market. For a major Japanese exporter like Murata, the value of the yen is just absolutely critical. So before we jump into the numbers, let's just quickly talk about what a weaker yen actually means for a global company like Murata. Think about it. Most of their sales are happening overseas, priced in dollars or other currencies. Now, when they bring that money back home to Japan, a weaker yen means every single one of those dollars buys more yen. So even if their sales in dollars stay flat, their revenue and profit in yen just automatically go up. It's kind of like getting a free bonus on every single sale you make abroad. And this slide right here shows you the impact perfectly. When Murata first made their forecast, they were planning on an exchange rate of 140 yen to the US dollar. But what actually happened? The yen turned out to be much weaker, averaging about 146 to the dollar. Now that 6 yen difference might not sound like much, but it's a massive tailwind. Murata themselves said that for every 1 yen change against the dollar over a full year, their operating profit moves by 4.5 billion yen. So yeah, this currency effect alone explains a huge chunk of their profit beat. But, the weaker yen was only part of the story. If you actually look past the currency effects, you see that inside Murata, there was this kind of battle going on between two very different parts of the company. The headline numbers were actually hiding this fascinating mix of incredible highs and some pretty significant lows. So on one hand, their core components business was just firing on all cylinders. Revenue from capacitors, especially their flagship multilayer ceramic capacitors, or MLCCs, grew a really healthy 9%. These are those tiny, absolutely essential parts that manage electricity in pretty much every electronic device you own. And likewise, inductors and EMI filters were up nearly 10%. So this side of the business was seeing some seriously strong demand. But then on the other hand, it was a completely different story over in their devices and modules division. I mean, look at this contrast. High-frequency modules, which are used heavily in smartphones, saw revenue drop by over 10%. And the battery and power supply segment, selling into markets like power tools, also fell by over 10%. So while one half of the business was absolutely booming, the other half was facing some pretty serious headwinds. So this sets up the really crucial question, right? What market trend could possibly be so powerful that it not only fueled all that growth in the components division, but was also strong enough to completely cancel out the declines in those other huge segments? Well, the answer lies in the single biggest technology story of our time. And you don't even have to guess. The company points to it directly. Just listen to this from their own statement. They call out stronger demand for our products driven by growth in the number of electronic components used in AI servers and peripheral equipment. This isn't just some minor trend for them. It has become a central pillar of their success right now. So what does that actually mean? Well, all that massive global investment in data centers and AI hardware created this incredible demand for their most advanced parts. Remember those MLCC capacitors we just talked about? AI servers need literally thousands of them to make sure the power is stable. And it's the same for their EMI suppression filters, which are critical for preventing electronic interference in these super powerful, densely packed systems. These are the high-performance parts that are fueling the AI revolution. And here is the proof. When Murata breaks down their revenue by what it's used for, the computers category, which includes servers, grew by an absolutely stunning 20.1% year over year. In a market where their smartphone-related revenue was actually falling, this 20% surge in the computer and server segment was more than enough to lift the entire company. That right there is the AI boom quantified. Okay, so let's look at how this incredibly strong first half, driven by AI and that weak yen, has completely reshaped their expectations for the rest of the year. Because with results like these, you can bet their old forecast went right out the window. So, no surprise here. Murata significantly raised its full year forecast. They've added 100 billion yen to their revenue target. That's a solid 6% jump. But the real story, the jaw dropper, is the profit. They boosted their forecast for operating profit, that's the core profit from their main business, by a massive 60 billion yen. That is a jump of over 27% from what they originally thought. That tells you they believe this strong performance is definitely set to continue. So, what gives them the confidence to make such a huge upward revision for the second half of the year? It's one thing to have a great first half, but it's another thing entirely to bet that the good times are going to keep rolling. What key factors are they seeing that we should know about? Well, it really all boils down to three key things. First, and this is the big one, they expect the voracious demand from the AI server market to just continue full steam ahead. Second, they're actually more optimistic now about their other markets. They're forecasting a rebound in sales for both smartphones and cars. And third, they're just being realistic about the currency, officially adjusting their exchange rate forecast to 145 yen to the dollar, basically baking that nice tailwind right into their new guidance. And this all leaves us with one final crucial thought. Murata's performance has been undeniably impressive. I mean, they have masterfully capitalized on the biggest trend in tech, all while benefiting from a super favorable currency environment. But with so much of this incredible surge tied to the red-hot AI market and those exchange rates, it raises a really key question about how sustainable all this powerful momentum truly is. What happens if the yen strengthens, or if the crazy pace of AI hardware spending starts to cool off? That, right there, is the billion-dollar question that's going to define Murata's next chapter.